and good day. I'm Jed Wonderly with Noble Home Loans, Certified Mortgage Planner, and you are watching the Wonderly Team channel. I've got a very special guest with me today. I've got a longtime friend, Bryan Granthem. He's with Mojave Capital, and I've asked Bryan to be on this episode today because he has a very special niche that I really like, and it's an investing niche that will allow a lot of my clients who have equity in their homes that's doing nothing for them to access that equity and really put it to work for them. What I mean is, let's say you have a home that's worth $300,000 and you only owe $150,000. If we were to do a cash out refinance and take out about $90,000 of that minus maybe a little bit of closing costs, let's just say you have $90,000, because then you have a loan amount of $240,000. You have 20% equity in your home, and you don't have to worry about mortgage insurance. Not to mention the fact that 80% is the cap for cash out. So if you take that cash out, now you can put it to work for you. In your home, it does nothing for you, because in your home it's debt equity. It is illiquid until you pull it out, and if your home is going to appreciate 5%, it's going to appreciate based on the value of your home. So if you have a $300,000 home that appreciates at 5%, it has nothing to do with how much equity you have in it. It only has to do with what's the value of your home. $300,000 appreciates 5%, now it's $315,000. So what Bryan does is gives us a very good, safe avenue to invest that money that you pull out and create a lot of wealth. And Bryan, I appreciate you being on the show today.
Thank you.
And why don't you tell us a little bit about, okay, we've got a client that just said, you know what, I like this, I need to get that money working for me. My 401k, if I have one at work, or my IRA or whatever, isn't doing it for me. The mutual funds that I'm invested in or whatever, it's a roller coaster. It's too unpredictable. I need something that's predictable, that gives me a solid rate of return. And it sounds like Jed might be onto something. He's brought Bryan on the show. So Bryan, tell me a little bit about how that works.
Great. It's a pleasure to be here. I always appreciate when Jed reaches out. I'm a principal at Mojave Capital. I've been in the industry for about 10 years. We specialize in first trust deed investing. That's what I would recommend at all times. First trust deed investing is just simply private loans that are collateralized by real estate, collateralized by real property. Not property out in the middle of the Arizona desert, but actual real valuable property. That
Here
pays locally. We do branch out, but we are a Nevada licensed mortgage broker that focuses on private loans, unlike conventional. These types of investments, the thing that I like about them is they're secure. They've got a lot of collateral, so there's a lot of security, loaning low loan to values. I'm sure if you've been working with Jed, you understand loan to value and all of those different terms. So you've got a low loan to value. We're oftentimes loaning 50 to 70% of what the property's worth, if not less. These are loans to investors, developers, builders, but it's real estate based, not to owner-occupied homes. We're not doing mortgages. These are private investment loans, maybe a house flipper, something like that. The returns are very steady, very safe. The span, to kind of show you how steady and safe they've been, for the last 50, 60 plus years, they've ranged between 8 and 12%. Never really goes lower, never really goes much higher. It's between 8 and 12%, and that's a fixed interest, an annual interest, paying out a monthly dividend. So if you're making 12% interest for a year loan, you're getting 1% every month paid back to you.
Now, 1% per month? Most people out there, if they got a money market at their bank or even a CD, don't get that in a year.
Correct.
And you're talking about 1% a month, 12% per year, and it's safe.
Correct. I teach my clients, one thing that I probably drive my clients crazy with is don't do what the banks are telling you to do do what the banks are doing. You go put your money into that CD, that money market at your bank. Sure, they're going to pay you 0.5%. And I hear all the time, banks aren't paying more than 0.5%. How can you get 10 to 12? Or how can you even get 8? How could you get 5? The difference is those banks, as Jed knows, they're working with Jed. They're using your money, paying you 0.5% on your money annually. Well, they're going out and loaning that money on mortgages, car loans, credit cards, and making anywhere from 4, 5 to 30% on your money. I just say reverse the tables. Become the bank. Loan your money out, collect those interest rates that the banks are getting, but do it in a safe, secure way where you've got collateral and fixed interest and security and consistency, unlike the market. You know, we talked a little while ago about realized versus unrealized gain.
Yes.
And I think at this point that's a very important thing to point out. And you kind of alluded to it in your intro here. When you're in the stock market, when you've got mutual funds, you've got stocks, the gain on that is what's called unrealized gain. It's like the equity in your home. If you buy a house for 300 grand and in 5 years it's worth 325 grand, you don't have $25,000 in your pocket. You've got $25,000 that's a number. It's a made up number by an appraiser saying that you now have $25,000 worth of worth. But if the market turns, that can disappear. It's an unrealized gain. You don't actually have, you don't have it in your hand.
So let me just relate that a little different way. So in 2008, 2009, we had a pretty big fall in the stock market. I would call it a precipitous fall. And so a lot of people who may have held, you know, a variety of stocks for a number of years, they had all this wealth. And if they'd held on to those stocks instead of cashing them out and putting that in cash, then over that next year or so, the stock market took about, what, a 40% fall, give or take. And so if you were in those stocks, some of them got hit a lot harder, some of them not quite as bad, but if we use roughly 40% as the number, then you're going to have about 40% less wealth. So if you had, let's say, a $500,000 unrealized gain, and that gets hit by 40%, now you're going to have a $300,000 unrealized gain.
Right. So
you've just seen $200,000 evaporate. And it's the same thing in our housing market that we experienced, you know, between late 2007 through about 2010, 2011, where, you know, a lot of people that had owned their home for 6 or 7 years prior to 2006, which was kind of the peak of the market, we had seen a lot of appreciation, got a lot of gains, and all of those were not only wiped away because we didn't cash out, but they were also now had negative equity. So Bryan, we did talk about unrealized gains, and you brought up some very good points, something that I've talked to my clients a lot about over the years. If, like for instance, maybe somebody had a $150,000 mortgage and their house was worth $300,000 at the prime, and that house went down to $100,000, $120,000. Now they're sitting with $30,000 negative equity.
Correct.
That $150,000 of equity they had just evaporated. Had they taken that out, if we did a cash out mortgage of $90,000 and now they were up to $240,000, what happens in that scenario?
In that case, if you take the cash out, what you've done is you've turned your equity into a realized gain. Sure, there's an opportunity cost. You've got a little bit of a higher mortgage payment. You've pulled cash out. That's where your expertise comes in. You've got a little bit higher mortgage payment. You've got this money out. And if that's now invested, it's producing income for you. Again, these are realized gain investments. You're getting that dividend paid to you every single month. So now if the market crashes and your home goes from, I think the example you said was worth $300,000, now it's worth 150, 125. You didn't just lose that equity. You didn't lose your house. You didn't lose your net worth. You've still got that $150,000 or $90,000, whatever it is that you pulled out. You've still got that money liquid going to work for you. So now you've got a couple of options. You can take that money and put it back into your house, hedge yourself against that market, pay your house down, if not pay it off at that point because this money's been working for you. We can talk about Rule of 72 like we have in the past. It's working for you, it's growing, it's producing more money for you. So you can take that money and pay your house down and hedge your bet against that market.
But why would you want to do that if it's growing and working for you?
The other option that you have is, again, realized gain. This is producing a monthly income for you. So let's say that now you have a $100,000 investment. Say that 90's become 100, just for an easy number. You've got $100,000 that's working. That $100,000... Which,
by the way, over a year is just under a 12% return and something that's easily doable in the type of investments that Brian's talking about.
Correct. And so if you've got that $100,000 producing at that 12%, which I don't promise 12, it's deal by deal, but hypothetically, you've got a 12% rate of return, 1% a month. On $100,000, that's $1,000 a month income that's coming to you. So now you've got the extra income to continue to pay your bills, pay your mortgage, in the case of job loss or
something like that, but that's not what we recommend.
Right, right. Worst case scenario, you've got the expendable cash that can come in, pay your bills if need be, help pay your mortgage payment, and you don't lose your principal investment. You've already taken it out. You've realized that gain to make sure that you don't lose that in case of a market crash.
Now the other side of that coin though, Brian, is if you're using that income to help pay for bills and everything, then you don't have the compound interest effect that you would if
Correct.
you were to put that in like a side account, like a money market, and then when that note that they've invested in comes due, they get their principal back, they add their income that they've received from that investment, and now that 90 has become 100,000 as we talked about. Now they invest that 100,000, and that's where the real big returns start to happen, because then that 100,000 becomes 110, 110 becomes like 121, 122, etc. And so then it really starts to add up. So there's kind of two opportunity costs in this situation. There's one, what if I don't pull that money out? You lose that unrealized gain, it's all gone, now you have nothing to pull out and invest. You're not as upside down as you would have been had you pulled that out, but no one's forcing you to sell your home either. And we've just gone through that, a few years back, so it's not likely that we're going to go through that anytime soon, and hopefully never again, as long as we maintain reasonable levels of appreciation and stability in our housing market, which comes from stability in the job market, which it looks like we're improving nicely. So the main opportunity cost is if we don't pull that cash out, it sits in our home as debt equity, as unrealized gain, and now all we can really do is invest we can invest whatever we can. But if you look at it and you say, okay, well my payment at 240 would be X, my payment at 150 is Y, I'm going to go ahead and invest that difference. Maybe that's a difference of $300, $400, $500 a month, depending on what your original mortgage note was. And now you can try to grow your wealth that way, or you can really jumpstart it by pulling out that 90 and getting it working for you now. And that's where, hey, in 5, 10, 15 years, we talk about the Rule of 72 in episode 3 of how to avoid the most common and costly mortgage mistakes, which I'll put a link to down below. It's very important for you to try to make that compound interest, reinvest that, make that work for you. And then you've got doubling periods that, or if you get a 10% return on investment, it's 7.2 years. If it's a 12%, it's 6 years. If it's an 8%, it's 9 years. But either way, you're going to be able to take 90,000 and get it up to, 1.4 million, 2.8 million, or beyond over a period of 30 years, 35 years, something like that. And that is unheard of in the stock market because of the volatility that's in the stock market. And the stock market doesn't have the safety that Bryan does. So Bryan, talk a little bit more about the opportunity that's there, you know, the fact that, you know, it's safe, and the kind of vehicles that you like to use to invest that with.
Okay. So first, I agree with you. There's a very touchy point. The last thing that you can afford to do, if you pull money out of your home, the last thing that you can do is go throw it out there on that craps table, which is what I refer to the stock market. You can't go down, we're in Vegas, you can't go down to the casino and gamble it. You can't throw it into something that's up
Vegas,
and down.
baby. What happens here stays here.
You can't go down and gamble with it. No matter how good you are at trading, right, no matter how good your advisor is at trading, you can never get a guarantee that you're not going to lose. The only guarantee you get in the stock market is you will at some point lose. It will happen. So you cannot take that risk with your money, especially if you're pulling it from your home, and go dump it into something that's variable, that's up and down. Your options are, you got to get it in something that is consistent, that's fixed. Now, not just a fixed interest. We can go to our bank and get a low fixed interest. You're kind of wasting your time.
You're not even keeping up with inflation, and inflation's very low right
Correct.
now.
Much less the mortgage rate that's on your home.
Right.
The trick is you've got to be higher than that rate as well. If you pull out $100,000 and you've got a mortgage rate of 4%, you got to make more than 4%.
And not necessarily quite 4%, because there's the tax benefit of the interest as long as you're paying enough interest to itemize, but that's a whole different discussion. So.
Correct. So what you get with a first trust deed investment, and I'll give an example. If you have here's an example of a loan that I just did. We had a home that, and I don't know how many of you are here in Vegas or know Vegas, but in Anthem Highlands, in Anthem, there's Anthem Country Club. We did a loan on a home in Anthem Country Club. We loaned $250,000. This home valued, if we were to fire sell this home, it was valued about $680,000. In fact, we did the loan and it closed 90 days later. We had this loan paid back because the home got a cash offer at $680,000, exactly what we thought it would sell for if we had to fire sell it. So the home came in, $680,000. We had $680,000 worth of collateral, worth of security, and we loaned $250,000 on that.
And what kind of rate of return were your investors getting?
This loan was 10.5%. And the loan was set up for a year.
So you're telling me that you were at about 40% LTV, right around there, and at 10.5%?
10.5%.
Your investors were probably hoping the loan would go back.
I won't say yes, because I don't get excited about default at any point, but yes, on one hand you do look at that and say, let it default. It can default, because if it defaults, what happens is now, not me, you as the investor, this is your money, you're on title, not me. I might be on the loan with you. It's called a fractional loan. We can talk about that one-on-one, what that means. But it's your home. It's your money. If you had put up that $250,000 on that home, you're listed as the bank. You've got the equity. My job as the broker is to facilitate. Facilitate, if there is a default, facilitate that default. Facilitate the sale. And what ends up happening is, if it defaults, you now own a $680,000 home for $250,000. I don't know a person out there that wouldn't buy a $680,000 home if they could buy it for $250,000. So if we sell that home for $680,000, that difference, that profit, is yours as the investor. That's not my profit. So
just to be clear, because I'm sure a lot of the viewers are going to be thinking, well, I don't have $250,000 to invest. So,
right.
So if we did a cash out refinance and pulled out $50,000, there might be you and 4 other people we just pulled $50,000 out for who are invested in this. Mm-hmm. And so there's 5 fractions at $50,000 each.
Correct.
And that's what's going to fund this deal. And so you each have a 20% investment in it. Again, and in this case it was 40%-ish LTV, and that is extremely safe, and you would never expect, because most people don't understand this kind of investing, to get 10.5% very safely at a 40% LTV. Heck, at 70% LTV, that would be very, very safe.
Right.
So, Bryan, I know that we're running out of time here on this. We're going to do another episode where we talk about a few other things that are very important relative to what's the end game. Again, I would refer you to, we have another video where we talked a little bit about self-directed IRAs, and that's very important because now you're also not only getting a great return on your investment, but you're doing some great tax planning as well. And that video also talks a little bit about solo 401ks, and so I would refer you to that video. I will also put a link to that below, so check that out. And please like, share, comment, subscribe, all that kind of thing. If you subscribe, then you're going to be able to get, anytime we do a video like this, you'll be able to, get it in your YouTube feed, as it were. Again, you're watching the Wonderly Team channel. My name is Jed Wonderly. You can reach me at 702-812-1214. That's 702-812-1214. And this is Bryan, my special guest. Bryan, why don't you let them know how they can reach you?
You can reach me also on my cell phone is the best way to catch me. That's 702-581-1181. Again, 702-581-1181.
Thanks for watching, and don't forget to catch our next video, which is talking about the end game. Appreciate your time. Have a great day.